Hello everyone, thanks for checking out my video. Last Friday, major US stocks declined as investors took some profits off the table heading into the long weekend, right after the S&P 500 hit a fresh record high and Nvidia posted strong earnings. This latest pullback also came after the release of a new inflation data, which reminded investors that rising prices remain a risk going into a new month. But still, the S&P 500 managed to lock in a fourth winning month in a row. But here's something that you may or may not know. Historically, September has been a toughest month for the US stocks. Whether you look back 10, 50 or even 100 years, September has consistently been the weakest month for the US market. So now, with the bull market still running hot, the big question is, will this September break the tradition? And more importantly, how should we position ourselves as we head into this seasonally challenging month? Let's discuss all of them in this video. Be sure to watch until the end so that you don't miss anything, alright? Okay, the US stocks retreated from record highs last Friday as Wall Street digested a new set of fresh inflation data showing prices remain above the Federal Reserve's target. The PCE index, a key inflation gauge, rose as expected in July. Its core index, which is closely watched by the Federal Reserve, climbed 0.3% month-over-month and 2.9% year-over-year. This is the fastest annual pace since February and still above the Fed's 2% target. With the market sitting at all-time highs and SPX crossing the 6,500 milestone for the first time in history, the inflation data might have sparked some profit taking. All three major indexes finished lower, dragged down by weakness in big tech companies as investors lock in profits ahead of the Labor Day long weekend and the historically weak month of September. But still, despite the sticky inflation, the market is pricing in a Fed rate cut at the September FOMC meeting. The key debate now is the size of that cut, which will hinge on the upcoming labour market report. Anyway, even with last Friday's losses, the three major indexes wrap up August with solid gains, marking at least a fourth consecutive month of winning streak. In terms of the market outlook, investors will face a loaded September calendar. First of all, the US stock and bond markets will be closed on Monday, 1st September for the Labor Day holiday. Market will resume on Tuesday. The first major economic report is none other than the US August jobs report, which is scheduled to be released on Friday, 5th September. Investors will try to sense-make whether the previous weak labour market data was an abnormality. Alright, in case you're not aware, the last release of US payrolls data was surprisingly weak, and that has raised expectations that the Federal Reserve will start cutting rates again at its next meeting in September, as the Fed moves to support the labour market despite inflation worries. A soft employment report this coming Friday could raise concerns about a slowing economy, but it also might lead the market to price in a more aggressive cut to boost the economy. Next up, the latest CPI inflation data will be out the following week on 11 September. This will be followed by the September FOMC meeting scheduled to take place on the 16th and 17th. Investors are anticipating a 25 basis point rate cut from this meeting. On the company's front, semiconductor and software giant Broadcom will release its earnings reports on 4th September. Their earnings could have a ripple effect on the share prices of other semiconductor companies such as Nvidia, AMD and TSM. On 9th September, Apple will be holding its annual launch event. The tagline on the invite is "all dropping." Reports are saying consumers can expect a slimmed-down iPhone Air, a bundle of smartwatches and new AirPods. Apple is betting that it can attract more consumers and boost their sales with a super slim iPhone. The slimmer version of the iPhone is essentially the MacBook Air of iPhone, much sleeker but potentially at the expense of battery life and the camera. Okay, then on 17th September, Meta CEO Mark Zuckerberg will deliver a speech at the Meta Connect 2025 launch event, where he will share the latest updates on AI glasses and lay out Meta's vision for artificial intelligence and the metaverse. Okay, let's now move over to the technical analysis section. Sorry, a quick one. Just wanted to thank the viewers for watching my videos as I have received my 5th YouTube paycheck. These are the earnings from Google AdSense and super thanks. And as per past tradition, I have donated the money to another charity organization. Alright, I don't want to take up too much of your time, but if you appreciate my effort in churning out this weekly free content, you may consider supporting this channel through any of the following ways. Feel free to pause the video. Anyway, SPY's chart looks straightforward. In terms of bullish thesis, I have shared before, at all-time highs it will just continue to make multiple record highs until something really negative happens, then we will get a meaningful pullback. As you can see, SPY has created a series of new all-time highs since June this year, and every dip has been bought up for the last 2 to 3 months. So if this trend continues, if bulls step in again this or next week, then we can expect to see another new all-time high, which means 650 for SPY is on the cards. Honestly, like I always said, at record highs, it's almost impossible to predict when is the next major pullback. Just like we won't know if this current pullback will be the so-called major one, but we can take cues and signals from the price movement. The first signal is to watch the area 630 to 632 formed by the first Fibonacci support level and the 50 moving average. You can call this a double support zone. If this breaks, then that's the first sign that this pullback could be unlike the previous ones where shares get bought up so quickly. Okay, but ultimately for me, I would only say SPY's trend has turned bearish if it goes below 610, 611 area. 611 is the so-called pivotal 50% Fibonacci level, while 610 is the previous all-time high created back in February 2025. If SPY falls below this double support zone, then it's definitely a great opportunity for me to go shopping for shares. Moving over to Apple. Apple seems like it wants to validate and break out of this potential bull flag. So how do we know what does a breakout look like? Well, simple. Watch out for the recent high of 235.12. But if you want more certainty, then watch for the blue resistance line at around 236. If Apple can close above 236, then the bull flag has a very high chance of playing out. When that happens, I do think Apple will enter the 240s range at the very least. On the other hand, if Apple gets rejected at around 235, 236 levels, then we could see a mini double top pattern forming. That will then likely bring Apple back to below 225. If we see that sort of price movement, then obviously the bull flag has been invalidated. Okay, ultimately, if a pullback does come, the bulls would not want to see Apple going below the 200 moving average at around 220. Or perhaps you can stretch it to 219 where the 23.6 Fibonacci level is. Reason being, a close below these two levels will almost certainly bring Apple down to the gap area between 215 and 216. At this area, you might want to be on alert, because other than the gap, this is where the 50 moving average is, and it's also near the purple support line of 214. If we ever go below that purple line in September, I would say Apple's trend has turned bearish. And in case you missed the earlier part, mark your calendar. 9 September is the Apple product launch day. That will likely set the tone for Apple's share price for the remaining of the month. Moving on, let's check out Tesla. It appears that Tesla wants to invalidate this not very textbook version kind of bull flag. I would say Tesla is at a pivotal point and is about to pick its next direction. Let's break down the details. First of all, a break above a trend line followed by a retracement to retest that trend line is a very common price movement. As you can see, Tesla is now testing that blue downtrend line. What makes it interesting is that 200 moving average is sitting right at the trend line too, which is around 330. Not just that, at this 330 and 331 area, it lies the critical 61.8 Fibonacci level as well. And last of all, the MACD seems to be on the verge of having a bearish crossover, but it hasn't happened yet. Therefore, I would say this coming week would be the moment of truth for Tesla. Tesla might be picking a side soon. If the share price bounces off those levels that I mentioned, then it's pretty bullish. Before we knew it, the share price could jump 20 points from the 330s range to 350s range. Remember, a retracement followed by a rebound is typically bullish. On the other hand, if Tesla starts falling below the blue trend line and the 200 moving average, then the short-term trend is leaning bearish a little. For real bearish confirmation, it would be seeing the MACD having the bearish cross and the price falling below the 200 moving average. Because when that happens, if you were to count the bearish signals, that's 4 in total. Just one last point to add, if things turn bearish, pay attention to the level 314.6. If Tesla closes below this level, that means the series of higher lows have ended, and I would think there is going to be more downside ahead. Let's now move over to Google. Google looks unstoppable at the moment. It just kept going up, and the latest bullish signal is that it broke out of this uptrend channel. That's super bullish in my opinion. But here's the but. I think Google will have a Microsoft, Meta, and Nvidia moment. What does that mean? Check out the charts of these three stocks. All of them were on a monster run up prior to their recent retracement. I am very sure Google will see the similar pattern, we just don't know when. Again, let's look for cues and signals. When we have a breakout at all-time highs, yes, it can go higher and higher, but it also needs to take a break. It's normal to see a breakout followed by a retracement to retest the breakout. This means we can expect Google to retest the purple channel again at around 210. If it bounces off the channel, then the super bullish momentum is continuing. On the other hand, however, if it starts closing back into the uptrend channel, then there is a probability that it may grind towards the middle channel, which is around 206 or 207, give and take a little. This kind of pullback is very healthy actually. Ultimately, so long as Google doesn't fall below this uptrend channel, the whole bullish run is still intact. Meanwhile, as mentioned in my last video, the ruling from DOJ on their monopoly case could be out anytime. If it triggers a sell-off, watch that 201-202 support level closely. If it breaks, then the short-term trend has turned bearish. Moving over to Meta. Meta's chart is looking a little bearish. Let me explain why. Look at the last 5 trading days. They line up so nicely by creating a series of lower highs and lower lows. This is a classic bearish price movement. Come this week, watch the area between 729 and 735 closely. This area is formed by the 50 moving average and the 38.2 Fibonacci support level. If this area gets breached, then the huge gap between 708 and 731 will be the best target. They will definitely aim to fill it. If that happens, the next support to watch is the pivotal 50% Fibonacci level at around 708, which coincides with the bottom of the gap, thus forming a double support level. And if this level breaks as well, I believe we can say hello to 600's range again. Alright, in terms of the bullish thesis, if Meta can bounce off the current price point where the 50 moving average is, that's a positive sign. A reclaim of the 23.6 Fibonacci level at 755 is a signal that a retracement is potentially done and Meta is resuming its uptrend. That's when we could easily see Meta in the 770s range to fill that tiny gap. Okay, moving over to Microsoft. Microsoft was basically trading sideways for the whole of last week. The bulls and the bears have been having a tug of war at the 50 moving average for the last 8 trading days. Coincidentally, this is also where the 38.2 Fibonacci level sits at around 504. This makes the analysis a lot easier. If Microsoft breaks free and goes above the 50 moving average in a convincing fashion, then that is bullish. You might ask, how convincing is convincing? Well, we can use the 23.6 Fibonacci level as a reference. If Microsoft closes above this level at around 524, then the bullish trend is potentially resuming. On the other hand, if the chart prints a few candlesticks below the 50 moving average, then I think the probability of the share price falling to the pivotal 50% Fibonacci level is pretty high. This level is at 489. Okay, it really depends on how bearish or different this coming September is. If it follows the seasonally bearish trend, just don't be surprised that Microsoft might fall below 489 in the weeks ahead. Alright, let's now have a look at Nvidia's chart. Nvidia reported pretty solid earnings, but the share price is moving in an erratic manner. Initially, there was a 2% sell-off after its earnings results came out. But then when the market opens the next day, the share price recovered most of the losses and even went green during intraday, though it closed slightly red at the end of the day. Just when many thought all is good, the share price tanked 3.3% last Friday, more than the post-earnings sell-off. Some said it was due to reports on competition from Alibaba for their chips. Anyway, two key support levels to watch this week. The first is where it is right now, at around 174. This is the 23.6 Fibonacci level. In fact, Nvidia seems to be in this area of consolidation that started since late July. And just to share, I stepped in to sell a put option at this level. More on this in the options trading section. Alright, the second support level to watch is the 50 moving average at around 170. But given how volatile Nvidia can be, I might want to stretch it to the 38.2 Fibonacci level at around 168. So in short, watch out for this 168 to 170 area. If it breaks, I think we could be headed towards low 160s or perhaps even touch the 150s range again. As for the upside, if Nvidia can bounce off the current support level at 174, then everything is still nice and good. That's when I would expect Nvidia to go up to the top end of this consolidation area, which is in the low 180s range. And at low 180s range, I think there is a decent probability that FOMO buyers might just step in to push the share price to a new record high. Okay, let's now cover my options trades. I have 5 trades to update this week, which are all summarized on the screen. Alright, here's the first trade, a new cash secure put on Tesla that was sold on 28 August, Thursday. The strike price is $285 and the contract will expire on 26 September. The reason for selling this put option was pretty simple, and that is, Tesla's short-term trend is still leaning towards the bullish side since it broke above the blue downtrend line. Okay, I know it has been pulling back with the 3 red candlesticks, but I think the trend hasn't turned bearish yet, unless it goes back below the blue trend line again. Just to add, there are multiple strong support levels above my 285 strike price, mainly the blue downtrend line, the 250 moving averages, and the various Fibonacci levels you see on the screen, so I do think I have some margin of safety. But let's say if somehow Tesla breaks below all of them, my backup plan is to roll the contract. On the other hand, if the bullish trend is still intact, technically it should bounce off around the 200 moving average area. Next up, the second trade to update is another new cash secure put on Tesla. This contract was sold the next day on 29 August, Friday. The strike price is $265 and the contract will expire on 3rd October. The reason for selling this put option is similar to the earlier trade, so you can take it as I was doubling down on my trade. I know it may look scary with the big fat red candle last Friday. Well, I don't know about you, but my preference is to sell puts on a red day rather than a green day. Moving on, the third trade to update is this new cash secure put on Nvidia. The contract was also sold last Friday, 29 August. The strike price is $155 and the contract will expire on 3rd October. I actually recorded this trade live, so maybe I will post a YouTube short on Monday when the market is closed. Anyway, the thought process behind this trade was simple. Nvidia's earnings was great, and yet the share price was pulling back due to sky-high expectations set by the Wall Street, investors taking profits, and potential competition from Alibaba. So, the moment it pulled back to the first Fibonacci support level at around 174, I stepped in to sell a put option, which is a bullish move. If it bounces from here, great. But if it doesn't, it's okay too, because just like Tesla, to hit my 155 strike price, Nvidia needs to break below multiple support levels. I'm not saying it can't happen, but the odds are not that high. And even if it happens, well, 155 is about 30 points off the peak of 184.48. That's a 16% discount. It's not a bad idea to grab 100 shares of Nvidia at this price if one believes in Nvidia's growth story. Not financial advice, of course. Next up is this cash secure put on Tesla that expired on 28 August, Friday. The contract was sold on 16 July with a strike price of $245. My thought process behind this trade was shared transparently in the video linked at the top right hand corner, so I will not elaborate here. Anyway, since I sold the contract, Tesla did not even go below 300 at all, let alone bridging my strike price of 245. As a result, this contract expired worthless and I made a profit of around $270. Okay, finally the last trade to update is another cash secure put on Tesla that also expired last Friday 29 August. The contract was sold on 1st August with a strike price of 240. Similar to the previous trade, Tesla has been trading way above my strike price for the entire month of August. And so this contract also expired worthless and the profit for this trade is around $213. Okay, as mentioned at the start of the video, the S&P 500 clinched its 4th straight month of gains last Friday to close out August. Prior to that, it also closed above the 6,500 milestone for the first time ever. This bull market seems unstoppable at the moment. But as investors head into September, history suggests caution. Bank of America points out that September has been the market's weakest month going back nearly a century, with the index falling 56% of the time by an average of 1.17% since 1927. And according to the Stock Traders Almanac, September was the biggest losing month for the S&P 500, Dow Jones and Nasdaq since 1950. In addition, Bespoke Investment Group reported that over the last 10 years, the S&P 500 in particular has seen especially weak September performances as the index averages a 0.7 decline for the month. Well, it seems like no matter how you extract the data, be it the last 10, 50 or 100 years, September is typically the weakest month of the year on average. Some say that this seasonal selling pressure comes from pension funds and mutual funds rebalancing portfolios at the end of the quarter, where big funds often lock in profits before year end. They basically sell to either realize gains or harvest losses for tax planning. Okay, here's my personal take. As we enter this seasonally weaker period, I would not be surprised if the market continues to trend higher but at a slower pace. Reason being, as of the date of recording, I don't see anything on the horizon to knock this bull market off its path. But if something unexpected crops up, I will be here to update everyone. Okay, but with that being said, I also don't want to fight the potential bearish trend. In fact, if anything, if there is any volatility or pullback, it would be this time of the year in September or October period. So if the market does pull back, I personally see it as a great buying opportunity as the market is potentially setting up for a year-end center rally. Just to add, according to the Stock Traders Almanac, over the past 35 years, the S&P 500 has fallen 18 out of the 35 times in September, the only month to have been down more than up in that period. But if you look at it from another angle, it's almost a 50-50 chance. So who knows, this September could well be a green month. But of course, I wouldn't expect huge gains. Overall, I would say I'm very well positioned for the upcoming month. How about you? What's your plan? Staying out or waiting to deploy your cash on any signs of pullbacks? Let me know in the comment section below. With that, I will see you in the next video and don't forget to help me with the YouTube algorithm by tapping the like button, okay? Thank you very much.